Chief Investment Officer at Courtiers, Gary Reynolds, joins me today. Hi, Gary.
Leo.
Along with Hazel Compton, Content Manager. Hi, Hazel.
Hello.
To talk about value investing versus growth investing. Gary, Courtiers is a value investor.
Courtiers is a value investor, not because we've got some almost religious fanatical belief in value investing, but because Courtiers is primarily concerned with long-term investments for clients that have got long-term goals, whether they are private clients or whether they're small institutions like pension funds or charities. We are dealing with very long time horizons. And the moment you have long-term objectives, the moment you've got real objectives for cash over a long period, then value, in our view, wins hands down.
What's the typical traits then of a growth investor?
Growth investor, somebody prepared to take a bit more risk, probably trying to shoot the lights out. A growth investor is someone who thinks that they can get a better return than the market average, and they would do it by picking winners. And by winners, they mean companies that are likely to outperform. So companies that are going to make bigger profits than the average and keep increasing those profits in the future. So when you look at the two definitions, growth for a growth investor generally means buying a company whose profits are going to increase at a faster rate than the market. So if you're all the Mag 7 would at different times be classed as growth investments. So Nvidia certainly, and that's because the market expectation is their profits will keep rising almost exponentially.
So would you say a growth investor tends to invest with their own money more or other people's?
I think growth investors tend to be more speculative than value type investors. Because when you're investing in that certain way, when you're really trying to get the big winners, you also risk overpaying for stocks. And if things go wrong, you lose a lot of money.
I mean, would the typical growth investor characteristic be, this is my money, I'm a growth investor, or are there growth investment houses, companies out there?
Yeah, there are growth investment houses out there. There are companies. I mean, you could argue that a very popular fund at the moment, Terry Smith's Fundsmith, which has done remarkably well, has picked some decent stocks that have grown very, very fast. So there are funds out there that are called growth funds. I mean, interestingly, we call our above average risk fund growth, but it's actually not investing in a growth style. I think James picked that anomaly up when you did your recent monthly update with him. So there are those styles. People invest in growth. It tends to be a bit more momentum driven. In other words, you're picking stocks that are on the rise and you think they're going to keep going upwards forever.
Yeah, you say in your article that you even give an entire description of what you would do if you were going to be a growth investor.
Yeah, I did. Yeah, I did, Hazel, because I said, if you said to me, Gary, there is £100,000, I want you to beat the market over the next 12 months, I would do two things. I would probably invest with momentum in the first thing. So I'd look for the stocks that are on a run, and I'd probably then double the 100,000 by borrowing another 100,000, leveraging up the portfolio and trying to shoot the lights out. Now, I would have a reasonable chance of being in the top quartile, but I'd also have a very good chance of being in the bottom quartile as well. And if you invest in that way, you can have nasty shocks. And that is the type of risk that our investors don't want to take. And that is why we invest with value in mind as opposed to growth.
I want to bring back to value because that's what we do.
Yeah.
So you mentioned the security analysis book. Are you in the middle of reading this again?
No.
Nighttime reading.
Yeah, oh my goodness. I mean, it's a bit of a... It's not. I can't find an audio version of it. Otherwise, I'd catch up Buffett pretty easy.
So Buffett's read it 4 times.
He's read it 4 times. Yeah. And if you look at the 6th edition, he puts a nice foreword in there. That book educated Warren Buffett's view of investing, and the rest, as they say, is history. If Buffett is a great example of what long-term value investing can achieve. Because Buffett was used to investing for people that wanted reasonable long returns but didn't try to shoot the lights out. Now, in fact, Buffett shoots the lights out, but he does it in a way by not trying to shoot the lights out, because value in the long run beats growth, because what you pay for something matters, and that's key. But it's not just the returns that matter. It's the fact that you get this wonderful thing. If you can buy stocks that you're not paying huge multiples of the profits they're making. So the technical term is the price earnings ratio. The number of times the profit goes into the market capital value of the business is a very good measure of whether something's value or not. It's not the only one, but it's a pretty good one. The amount you pay is going to matter. And not only that, Benjamin Graham talked in his book Security Analysis about buying stocks at the margin of safety. Now, we use a phrase on investment team, which is we want assets or companies that can survive and thrive. So when they hit the bumps in the road, as you're inevitably going to do, because economies get bumpy every now and then, odd things happen, COVID-19 rocks up and upsets everything in 2020. You want the business you've invested in to be able to get through the other side. You don't want it to collapse at the first. It's if you like, it's the three little pigs, isn't it? It's what? How did you build your house? Well, it went up pretty fast with sticks. But when the big bad wolf comes along and blows hard, it all goes to pieces. Better to take your time and build it with bricks, and then you can survive and thrive the other side of it.
And it's about time. It's about getting through your life comfortably and achieving what you want to achieve, isn't it?
Yeah, but remember, we've been doing this a long time. The business set up in '82. You've got investors that have been with us for well over 30 years, sometimes 40 years. And they've gone through the ups and downs, but we've steered them through the downs and done reasonably well in the ups. So that I think is what the whole point of private client investing is for. A key thing for private investors to think about when they're investing money is not looking for the best return, but looking to tick all the boxes, do all the things they want to do in as lower risk way as possible. And that is the secret of good personal investing.
Gary, we look at charts, and you feature some in your article, which is available on our website, and you compare growth and value, and they go up and down and up and down and up and down. What if you could consider this on an emotional impact of a growth investor versus a value investor? Might the chart look like over time if they were to reflect people's emotional journeys investing in either growth or value?
I'd say the growth investor likes to win, and they're prepared to accept the big losses in return for feeling that they've beaten everybody else. I guess that judging by the popularity of gambling, which has been a popular pastime for human beings for a long time, then you'd think that there's a propensity to want to win. A sense of, the lottery is one of the worst value investments you can do, but people still do it. Why? Because they like the feeling of winning big, and I think that's what the growth investor looks for, and they're prepared to take the downs in return for the ups. The value investor says, look, I want my capital to deliver my cost of my holidays, the repairs and the upgrade of my house, supporting my grandchildren, my children, paying my electricity bill, all those things, going out for a nice meal. As long as I can do that, I'm happy. So the value investor is more likely to be concerned with life than the excitement of winning big. Now, just to clarify, I am not passing the buck on saying that any equities investors should accept substandard investment returns from the equities investment team, because as those charts prove, in the very long run, the value investor should win. So it is a well, if you like, it's a win-win, no-lose situation. As long as you can put up with the times when growth is flying and you don't get sucked into going for it, then the value investor, in being conservative with the little c and not being particularly competitive to actually be at the top of the pops, would actually be up there in terms of the better results. And I think you can see that from, if you look at our growth fund, it's upper quartile over 15 years, 10 years, 5 years. And yet it invests in a fairly cautious way compared to other more aggressive funds, but it tends to win out in the long run. So you're not sacrificing performance by going for value, but are you going to experience that up when the top companies, the Mag 7, are flying over 6 months? No. So this is actually a good example of when it's not so much fun being a value investor right now. But if you're prepared to sacrifice those very big short-term ups, you'll get a lovely long-term result. And most importantly, you'll do all the things you want to do in life without the risk of not being able to do them. And that, I think, is key.
And value has outperformed growth if we look at the performance since 1974 to date.
One thing you keep saying, or you keep putting together, is you keep saying long-term value. So is there such a thing as like a short-term value investment, or is it that is like long-term and value are the same thing and short-term and growth are the same thing?
So you know, when you asked me about what I would do to win over the short term, and I said probably go for momentum and do stacks of leverage. Well, actually, at the moment, you could actually take a policy and if challenge with that view. Go and be top of the performance over a year. One strategy you could employ today is be heavily value orientated, because the UK market has been cheap. It's actually performed quite well this year, but we've been saying it's been cheap for a while. Europe looks fairly cheap. What looks expensive is the stuff that's done really well for the last 3 years. So you could take a contra view and you might smash it over the next year. I think a good example, Hazel, if anybody looks at what happened in 2022, when growth fell out of bed a bit and underperformed, it was a bad year for stocks generally, but not for us relatively. We were far more defensive, so we did really, really well that year. We did less well in 2023 and 2024, where those stocks that had such a bad 2022 recovered. So you could say, does value work in the short term? Sure it does. And it could work at a time like that. It worked in 2022, and you could take a contra view and say, I'm going to buy all these lovely low price stocks with great balance sheets, great cash flow, good profits. And if the market suddenly agrees with you, you stuff everything else. That would work well. The other thing would work well if things fall out of bed. And you saw this again. It happened in 2022, but it also happened in 2025, which James will cover at the seminar. When we had the announcement, the announcement of the tariffs, the stocks that did really bad were those big growth stocks. They had a terrible time. So at one stage, they were lagging the market massively through early summer. So again, that would have meant if you'd gone value, you were outperforming hugely. So you can use value short term, but most value investors are really thinking, they're not really trying to smash it over 6 months. They're trying to smash it over 16 years or 10 years.
Yeah, they're understanding the long-term view rather than... Yeah.
Is it right to say that value is generally less volatile than growth?
Yeah, that's a fair point. Value can still be volatile, but it should be less volatile. It should be less volatile than growth. And also, you get a more defensive type of asset.
I was just thinking then that diversification may be more difficult within growth because it's dominated by a smaller group of companies. I might be wrong.
No, you're right. We are more diverse in our cautious and balanced funds because they have to hold a different range of assets.
So is it easier to diversify as a value investor?
Yes, it is. Because you haven't got to find companies where you think earnings is going to keep growing at above market rate. You can pick a broader range of companies. And if you're a value investor in a multi-asset fund, like, let's just use cautious and balanced as examples, you've got other types of assets in there. infrastructure, bonds, other things go in. And that level of asset type diversification provides a much smoother ride for the investors. Doesn't take out all the volatility, but one of the things that is key with our funds is that growth is more volatile, than balance is more volatile than cautious. And that has been consistent. And the good thing is these days, I know when you talk to the private client advisors at courtiers, they do all this work on cash flow analysis and risk and return analysis to show somebody what they can get out from their investments fairly predictably to enjoy a certain standard of living. So that's the key thing that you should do.
Yeah, they can explore certain scenarios, can't they?
So we've talked a lot about value investing. How does it actually relate to courtiers' funds?
So we always screen the stocks we put into the funds, whether they're the multi-asset funds or the equity funds, for value trades. The difference is that in courtiers' multi-asset funds, you're focused on value, but you're also more focused on diversification. So one other thing that we will look at on the multi-asset funds is how do these asset classes work together? In other words, if I put in a certain asset class, does it diversify the risk? So if I buy Barclays Bank, how does that affect everything else we've got in there? Within the pure equity funds, you don't have to worry about the multi-asset side to it. So it's different, but the same screens are run across. But we can hold more growth orientated stocks in the multi-asset funds as well. For example, we don't hold emerging market stocks in the equity funds, but we do hold it in the multi-asset funds. But even those emerging market stocks will have value scores. So we're always looking at them and investing in a certain way. And then sort of you can choose markets that are better value. So we are more weighted towards the UK than the MSCI UK weight at the moment, because the UK market is seen as much more value orientated than, say, the S&P 500. I'll give you an example on that. Nvidia went through $5 trillion in terms of market capital value recently. So what does that? Puts it about 3.8 trillion pounds. You can buy you could take that money, you could buy the whole FTSE All-Share Index, nearly 600 stocks for 2.8 trillion and still have $1 trillion left over. So Nvidia is bigger than the whole UK market. Now, where do you want to put your money? Do you want to put all your money in Nvidia, or would you like to buy this vast basket of much lower priced UK stocks? I know where my money is for the long run, and it's on the UK. And perhaps another debate is it's not all doom and gloom as everybody thinks. It's not great at the moment with the budget coming up, but I tell you, there's good things in the UK too. So
a lot of good companies doing good things.
There's a lot of great businesses doing good things. And I'm old enough to remember the 70s, and I can tell you there are echoes of the 70s in what's going on in the market today. Labour can't cut public spending. Couldn't cut public spending under the Wilson government in 74, 75. And eventually it turned around, and it turned around big time. But we've got to decide as a country what we want to do first, so I've digressed.
Budget.
It's
coming up.
Yeah.
Gary, Hazel, we're going to have to wrap up for now. It's been a very insightful conversation. Thank you. If you have any questions you want us to put to Gary or to the investment team, jump on our website, speak to your advisor, drop us an email.